The VIX has slid over the past few weeks, but investors appear to be getting more nervous about a couple of sectors in particular. Welcome to Trading Nation. I'm Eric Chemi, joined by David Seaburg of Cowen and Company and Nicholas Cullis of Convergex. Nick, where is the anxiety right now?
Well, it's certainly not in big cap stocks, right? Because the VIX is down from 16 to 13 just in the past couple of trading days. And so volatility there isn't really what we're looking at. However, you look at volatility in obviously the bond complex, but more importantly, stocks that have keyed off of the bond complex for this year, those dividend paying stocks like in utilities or consumer staples. And there you see volatility pick up 15 to 20% in the last couple of weeks. And so that's where the volatility really is.
So then, David, if we're looking at a VIX that can go down, but then other sectors go up, what is an investor to do? What's the one metric they should be focused on the most if you're getting these conflicting signals?
Well, I think it's about trends, right? I mean, I would be selling every rally in consumer staples. I'd be selling every rally if there's a rally in the utility names. I mean, we are in a very different period right now from a sentiment perspective. And I'll tell you what, people piled into these sectors like just blindly trying to buy and chase yield, which is just insane in my opinion, but they drove the prices of a lot of these stocks up. We're looking at charts right now from a technical perspective that look terrible. You look at Procter & Gamble. I mean, I think it's the highest weighting within the XLP. It looks awful technically. It's breaking down. It's breaking a very long, trend line. I look at Procter & Gamble and say, there's a name you sell on any strength. I look at the XLPs. I'd be selling those on any strength, and the XLUs. I'd be any sort of bounce that you get. This is not a sector that you want to buy the weakness because it looks optically, from an optical perspective, it looks cheap. The sentiment shift has been great. It's fierce. Money is exiting these sectors, and it's not going to come back.
Obviously, when you think about these couple of sectors, they look a lot like bonds, right? They're not necessarily the big-time stocks that we would normally see like tech stocks. So how should investors think about this? Should they think about them even like stocks at all, or treat them almost like they are bonds?
Well, they were treating them as bonds. I mean, that's the problem. They were really just looking at them from that perspective. And I think, again, blindly jumping in and buying some of these names just for yield, which is crazy, not even looking at the fundamental picture on a lot of these stories. So too far too fast in this sector from the standpoint of the move up, unjustified, if you will, from a fundamental perspective. And I look at it and say, unlike the semiconductors where you see justification in the fundamentals for the move that we've seen, and expectations that are intact with the moves that we've seen, these names, they took off for one reason only, yield, and it was chased on that premise, and now it's coming off because that is completely out of favor, and in my opinion will be out of favor for a very long time.
And Nick, what do you tell people who just say, I want to chase yield, I see these numbers, I see these stats, I see yield, I don't need to know fundamentals? Think people can get away with that for a while or no?
No, I think David really nailed a lot of the macro issues here. You got to take a deep breath right now because rates are changing in a way that they haven't changed in the last 25 years because of what happened during the election and because of plans for fiscal stimulus in the next couple of years. You have to wait and see where rates shake out. They could end up, the 10-year could end up being 3% before it ends up being 2.25%. And so you have to wait. Take a deep breath. Understand the need for yield is great, but take a deep breath and wait. The story's not over yet.
That is going to be quite a move if it goes to 3% before 2.25%. So we'll have to hang along for the ride. And again, David and Nick, thanks for joining us here on Trading Nation.
Thank you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.